And a new trading day is underway on Wall Street. We have got Alicia Levine, BNY Mellon's Chief Strategist, joining us this morning, along with Jared Blickery, who's taking care of the charts, and our own Brian Sozzi. Good morning to you all. Alicia, I want to start with you. We have the Dow up, I see, about 70 points here out of the gate. Why is the market higher when we get news that another 4.4 million Americans have applied for unemployment benefits?
Look, it's a great question. Look, the thing is, the Thursday claims, the jobless claims that we get every Thursday at 8:30 in the morning are probably going to show incrementally lower numbers going forward, because as businesses are able to get their hands on the PPP loans, you should see some stabilization in the unemployment claims. Now, this is nothing to celebrate at all. But the markets always trade on the incremental direction, and the incremental direction is marginally better. Having said that, we're sitting here today at a 17% unemployment rate, which is really a disaster for the country, because the longer that this goes on, the greater the likelihood that those individuals who are filing for unemployment become detached from their employers. And that means when the economy reopens, it's going to be very hard to really jump-start it in the way that the market's pricing in.
Alicia, true story. I just got in my email inbox one note that suggests we're in a Great Depression too, and that the April jobs report might show a net job loss of 21 million. And my question to you is, do you think the market just needs to reprice? Does the bottom have to drop out here?
I think the expectation of market participants is that we are there currently, that we're in the Great Depression, and that in a sense, the news can't get much worse, because it's been no secret. I mean, all the sell-side banks are revising down GDP estimates for the second quarter. I think the lowest we had was a negative 45% for the second quarter. Hard to get worse than that. Having said that, on a fundamental basis, looking forward, we think that the market is pricing in this V-shaped recovery, meaning that the second half looks better than the first half. While true, in fact, we do think that the restart is going to be very difficult, not least of which what Dr. Fauci talked about in the last couple of days, which is we're going to get a second wave. And I'm not sure how we reboot this if that's the case.
You know, Alicia, do you think we have a large enough fiscal stimulus program to sort of bridge the gap here between the sudden stop and the resumption of normal economic activity? When you take it as a whole, together with everything the Fed is doing as well, is it enough?
So that's really the big question. And this is where duration really matters. Where we stand today, and what really helped the market rally, is that between the fiscal program and the monetary programs, the government's essentially putting 20% of US GDP towards a bridge loan for individuals and small and large companies across America. That is historically high. The fiscal policy in 2009 was only 5% of GDP. So this is really high. The issue is it really can only bridge the gap if we're talking about 2 months, maybe 3 months, which means if this goes longer, you need more money towards this. And that's really where we see some disconnect. And so we think the market's going to consolidate here as it tries to price in when, in fact, we can restart.
Do you think, Alicia, that the markets are priced for perfection here?
The markets are priced for a very deep fall in the first half and a sharp recovery in the second half. We did some modeling of EPS estimates. If you get a longer shutdown this round, or even a second shutdown, you wind up with EPS estimates in the 110 range for 2020, and then you go flat after that for 2021. And so you really get to very dire EPS estimates. And if you think it takes 3 to 4 years to recover to that 165, it could be that markets take that amount of time as well. But if we do get that more optimistic scenario, and if we get any indication of treatment efficacy, and the fact that we have all these scientists and companies working at this, you're going to put a floor into the market almost immediately, and you'll get much higher multiples.
Alicia, isn't the bigger problem here, and one investors have to really think about, is that the government and the Federal Reserve can't solve this situation? I'm hopping onto some of these earnings calls, and they're absolutely dreadful. Consumer demand has fallen off a cliff in April, despite some of these stimulus checks starting to hit bank accounts.
Look, Brian, that is exactly the case. So this is really a loan. It's impossible for the fiscal stimulus to actually stimulate any kind of demand because, most of the country is under a lockdown. You've seen the numbers for movie theaters. Nobody's going. You've seen the number for flights. Nobody's going. Restaurants, their bookings are down 100% across the entire country. So people have money in the pockets, but they can't stimulate the economy by spending it in these consumer-related businesses. And that's really the problem. So while you can do a loan to companies, if there's no business on the other side of this, you have a solvency problem. You may be able to bridge a small gym for the next couple of months, but who's going to that gym in June? And that's really the question. Do business owners have a business on the other side? And if you're in close quarters, consumer-oriented businesses, you just might not.
Yeah, I mean, it's incredible. I was reading about the restaurant industry yesterday. Some are saying they're going to have to take tables out of some restaurants so there can be adequate social distancing, and even change the vents in some restaurants to make sure that, the vents aren't blowing somebody's air onto somebody else. I mean, it's an incredible reworking of the way the restaurant industry can operate. I want to get over to Jared Blickery, though, now, because he has some bright spot for us, Jared. I think I'm speaking for everybody when I say we need a little bright spot right about now.
All right. Well, let's go for this. I'm looking at some sectors here. This is sorted by performance. So we're seeing energy leading. And one of the things I noticed over the last few days is even when crude oil went negative, energy really didn't sell off that much. In fact, it was gaining on the day when May contract went negative to negative $40. So there might be some accumulation there. We might be bottoming. I don't want to give the all clear just yet, but crude oil prices in general have been recovering, albeit at a slow pace. Then we have industrials also up, and healthcare and materials. So we see the value in cyclical plays leading today. We do have the 10-year T-note yield up just a little bit. And then we can also take a look at the NASDAQ 100. So we have all the FANG stocks in the green. Amazon is up 2.5%. Facebook almost there along with it. If we sort by performance, we'll see Wynn Resorts. That's a stock that's been really beaten down, still off year to date. Let's take a look here. About 45%, but since the bottom in equities 21 days ago, it's now recovered about 14.5%. After that, we see Expedia, the railroad, CSX, they just reported earnings. They're up 3.5%. And to the downside, we see Xilinx, Dollar Tree, and Biogen. Those are some of the stocks that are most in the red here on the NASDAQ.
All right, Jared, thanks so much. And our thanks, as always, to Alicia Levine of BNY Mellon. Thanks for being with us.
Hey, investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.